Imagine waking up to find that the gold bar you bought last year is now worth twice as much in purchasing power. On this Monday, January 19th, 2026, that reality is closer than ever as gold has just surged to a staggering fresh all-time high of $4,700 per ounce. But this isn't just a number on a trading screen. This is a global alarm bell ringing louder than ever before. While the world was distracted by stock market volatility and crypto swings, the oldest form of money in human history just sent a clear message. The global monetary system is shifting, and it is shifting fast. Let me paint you a picture of what this really means for you and your family. If you had taken just $10,000 and bought gold at the beginning of 2024 when it was trading around $2,000 per ounce, that investment would now be worth over $23,000. That's not a lucky bet on some startup company or a risky cryptocurrency gamble. That's the power of recognizing a major shift before the crowd does. And here's the critical part. This move isn't over. In fact, many experts believe we're only in the second inning of a 9-inning game. To truly understand the magnitude of what we're witnessing, we need to step back and look at the journey gold has taken over the past few years. Just 5 years ago, gold was trading around $1,800 per ounce. Many so-called experts on financial television called it overvalued. Some predicted it would fall back to $1,500 or even lower. I remember watching interviews where analysts laughed at the idea of gold ever reaching $3,000. Well, those analysts aren't laughing anymore, and the investors who listened to them and stayed away from gold are now watching from the sidelines as one of the greatest wealth transfers in modern history unfolds. But something fundamental changed in the global economy starting in 2020. The pandemic forced governments around the world to print money at an unprecedented scale. We're not talking about billions here. We're talking about trillions upon trillions of dollars, euros, yen, and every other major currency flooding into the system. Central banks slashed interest rates to zero and beyond. They bought government bonds by the boatload. They essentially promised to do whatever it takes to keep the financial system from collapsing. And now, years later, we're seeing the consequences of those decisions playing out in real time. The bill is coming due, and it's being paid in the form of a weakening currency and skyrocketing gold prices. The current surge to $4,700 isn't happening in isolation. When we examine the broader economic landscape, we see a perfect storm of factors converging simultaneously. Think of it like a hurricane forming in the ocean. You need warm water, you need the right atmospheric conditions, you need multiple systems coming together. That's exactly what's happening in the gold market right now. We have inflation that, despite what official numbers might say, is eating away at your purchasing power every single day. Go to the grocery store, fill up your car with gas, pay your electricity bill. You know the real inflation rate, and it's much higher than what the government reports. Real interest rates, when you account for actual inflation, are still negative in several major economies. Let me explain what this means in simple terms. If you put your money in a savings account earning 2% interest, but real inflation is running at 4 or 5%, you're actually losing money every single year. Your account balance might show a bigger number, but that money buys you less and less. This is financial erosion happening in slow motion. And in this environment, gold becomes not just attractive, but absolutely essential for anyone who wants to preserve their wealth. To understand why gold is suddenly going vertical, we have to look at the unprecedented headlines coming out of Washington and Davos this week. We are seeing a unique combination of geopolitical tension and economic uncertainty that we haven't witnessed in decades. The latest threats regarding international tariffs and the shifting stance on global trade have sent shockwaves through the currency markets. Trade wars that seem to be cooling down are now heating up again with a vengeance. Nations that once cooperated freely are now viewing each other with suspicion and hostility. Supply chains that were painstakingly rebuilt after the pandemic are facing new threats of disruption. Let me give you a real example of how this affects ordinary people. Imagine you run a small manufacturing business. You depend on imported components from 3 different countries. Suddenly, tariffs are announced. Your costs go up by 20 or 30% overnight. You can't absorb that cost, so you have to raise your prices. Your customers start buying less because they can't afford the higher prices. This scenario is playing out across thousands of businesses right now. And when business owners see this kind of instability, they start looking for safe havens. They start buying gold. The ripple effects are being felt across every asset class. The stock market, which had been riding high on hopes of economic stability, is now experiencing violent swings that would make your head spin. One day we see gains of 2%, the next day losses of 3%. I've been watching markets for years, and this kind of volatility tells us something very clear. Investors are uncertain, confused, and desperately searching for direction. Nobody really knows what's coming next, and that fear is palpable. In times like these, when uncertainty reigns supreme, gold has historically played a specific role. It becomes the anchor, the steady hand, the one asset that doesn't depend on anyone, direct promise, or any government instability. Here's what's really fascinating. Investors are no longer asking if they should own gold. That question has been answered. Now they're asking if they own enough. This is a critical shift in sentiment that cannot be overstated. Just 2 years ago, the narrative in financial media was all about technology stocks, cryptocurrencies, and high-growth investments. Gold was often dismissed as a relic, a barbarous metal with no place in a modern portfolio. I heard people say things like, gold doesn't pay dividends, gold just sits there doing nothing. Gold is for old people who don't understand technology. But that narrative has completely reversed. Now, the smartest money in the world, the institutional investors who manage trillions of dollars, are quietly but aggressively accumulating gold. When the world's reserve currency faces questions about its long-term stability and independence, capital doesn't just sit still. It flows into the ultimate sanctuary. It flows into gold. The US dollar has been the backbone of global trade for nearly 80 years, ever since the Bretton Woods Agreement after World War II. But that dominance is being challenged in ways we haven't seen before. Countries are signing bilateral trade agreements in their own currencies, completely bypassing the dollar. Oil, which has been priced exclusively in dollars for generations, the so-called petrodollar system, is now being traded in yuan, rubles, and other currencies in certain markets. This de-dollarization trend is not some conspiracy theory or fringe idea anymore. It's official policy in several major economies. Russia, after facing severe sanctions, has been actively working to reduce its dollar exposure and has largely succeeded. China has been steadily increasing the international use of the yuan through its Belt and Road Initiative and bilateral agreements with dozens of countries. Even traditional U.S. allies in Europe and the Middle East are quietly diversifying their currency reserves. Each time a major economy takes a step away from dollar dependence, the case for gold as a neutral, universal store of value becomes stronger and stronger. But here's the real story, the one that should honestly keep every investor awake at night. It's happening behind the closed doors of central banks around the world. For the third year in a row, central banks are buying gold at a pace that hasn't been seen since the 1960s. Stop and think about that for a moment. Central banks are the institutions that literally control money supply. They set interest rates. They are supposed to have ultimate confidence in the financial system because they run the financial system. Yet they are buying physical gold in quantities that suggest they are preparing for something significant, something they're not telling the general public about. Why are they doing this? Because they are de-risking. They are watching the global debt levels spiral completely out of control, and they realize that physical gold is the only asset with no counterparty risk. Let me break down what counterparty risk means in plain English. When you own a government bond, you're depending on that government to pay you back. What if they can't or won't? When you own a corporate bond, you're depending on that company to remain solvent. What if they go bankrupt? When you own stocks, you're depending on the business to perform well and the market to remain functional. What if there's a systemic crisis? But when you own physical gold, you depend on absolutely no one. It has value because of what it is, not because of what someone promises it will be worth. It has been valuable for 5,000 years, and it will be valuable 5,000 years from now. From Beijing to New Delhi, and even across European capitals, the mandate is crystal clear. Accumulate gold at any price. The People's Bank of China has been adding to its gold reserves month after month, reporting increases that many analysts believe are actually significantly understated. There's strong evidence suggesting China owns far more gold than it officially reports. India's central bank, despite having massive gold holdings already that go back generations, continues to buy more every single quarter. Poland, Hungary, and other European nations that want to assert more monetary independence from Brussels and Washington are rapidly building up their gold stockpiles. Even central banks in Latin America and Africa, regions that historically held very little gold, are joining this trend. This isn't just about diversification or following some academic portfolio theory. This is about preparation for potential crisis. Central banks are preparing for a world where the current monetary system might not function as smoothly as it has for the past several decades. They are preparing for scenarios where currency crises could spread rapidly across borders like wildfire. They are preparing for a reset, whether that reset comes gradually over years or suddenly over weeks. And when the very institutions that create money out of thin air are this worried, when they're buying physical gold hand over fist, individual investors should be paying very close attention and asking themselves hard questions. JP Morgan analysts are now suggesting that $5,000 per ounce is not just a possibility for 2026, but a near certainty. Read that again. $5,000 is considered nearly certain by some of the smartest analysts on Wall Street. These are not fringe commentators writing sensationalist blog posts to get clicks. These are analysts at one of the world's largest and most respected financial institutions with a 200-year history. Their research departments have access to data and insights that most investors can only dream of. They talk to central bankers, finance ministers, and major institutional investors every single day. And their models, which account for central bank buying, investment demand, jewelry consumption, and mining supply, all point in the same direction. Higher prices are coming, and they're coming soon. Other major banks are joining this chorus, and it's becoming louder by the week. Goldman Sachs recently revised its gold price targets upward for the third time in 6 months. Bank of America, OMS commodity research team is talking about gold potentially reaching $6,000 within the next 18 months if certain geopolitical scenarios unfold, scenarios that are looking increasingly likely. UBS Wealth Management is advising its high net worth clients, the people with tens of millions of dollars, to maintain significant gold allocations of 10 to 15% of their portfolios. When institutions that manage money for the world's wealthiest families, people who have preserved wealth across generations, are giving this advice, it's definitely worth listening to. We are also seeing a massive technical breakout on the price charts that has traders extremely excited. For months, from August through December of last year, gold was consolidating, moving sideways, testing the patience of even the most seasoned bulls who have been in this market for decades. Gold traded in what seemed like an endless range between $3,800 and $4,200. Every time it seemed ready to break out to new highs, it would pull back and disappoint the bulls. Every time it looked weak enough to break down, buyers would mysteriously step in and support the price. This kind of consolidation, where price moves sideways while building energy like a coiled spring, often precedes major directional moves that can be spectacular. But now that the $4,600 resistance level has been completely shattered, the sky is genuinely the limit. Technical analysts who study chart patterns and price movements for a living are pointing out something crucial. There is very little historical resistance above current levels. When gold was at $2,000, there were countless investors who had bought at higher prices during previous peaks in 2011 and 2012 who were waiting to sell and just break even. Those resistance zones created natural selling pressure that capped rallies. But above 4,700, we're in completely uncharted territory. There is essentially a vacuum of sell orders above these levels, which means the move to 5,000 could happen much faster than the move from 3,000 to 4,000 happened. The psychology of round numbers also plays a fascinating role here. $5,000 per ounce is a massive psychological milestone. When gold approaches that level, and it will, media coverage will intensify dramatically. Every financial news channel will be talking about it. Your relatives will start asking you about gold at family dinners. Retail investors who have been sitting on the sidelines watching nervously will feel the fear of missing out become overwhelming. That wave of new buying could push prices even higher, creating what technical traders call a momentum surge or a melt-up. We saw this exact pattern when gold broke through $1,000 back in 2008, and again when it crossed $2,000 in 2020. History doesn't repeat exactly, but it often rhymes in ways that are almost eerie. For the global investor, whether you have $10,000 or $10 million to invest, this is a serious wake-up call. We are moving into a post-pandemic regime where $4,000 is the new $2,000. Just as it seemed impossible that gold would ever sustainably trade above $1,000, and then impossible that it would stay above $2,000, the same skepticism exists now about levels above 4,000. But what if this skepticism is completely misplaced? What if we're entering an era where the factors supporting gold prices, persistent inflation, currency instability, geopolitical tension, are not temporary disruptions, but structural features of the new global order? Think about your own portfolio for a moment. Be honest with yourself. How much of it is denominated in paper currencies that can be printed at will? How much of it depends on the continued stability of governments that are drowning in debt? How much of it depends on corporations or financial institutions that could face serious trouble in the next crisis? How much of your wealth would maintain its value if we saw a serious currency crisis or a major financial system disruption like we saw in 2008, but potentially worse? These are deeply uncomfortable questions to ask yourself, but they're questions that more and more investors are asking themselves every single day. And the answer they're arriving at, often reluctantly, is that some meaningful allocation to physical gold, whether 5%, 10%, 15%, or even more, is not just prudent, but absolutely necessary for financial survival. The smart money isn't waiting for more confirmation. They were not waiting for gold to hit 5,000 or 6,000 before they decide it's a real trend worth paying attention to. They're buying now, right now, while the move is still in its relatively early stages. They understand something crucial about markets. By the time something becomes obvious to everyone, by the time your cab driver is giving you stock tips, most of the gains have already been made. The window of opportunity, where gold is clearly breaking out but hasn't yet reached levels that seem absurd to mainstream investors, is right now in this moment. This window might stay open for weeks, or possibly months, but it will not stay open forever. Windows close, and they often close faster than anyone expects. As you watch the headlines this week, especially from the annual gathering of global elites at the World Economic Forum in Davos, Switzerland, listen very carefully for certain keywords. Listen for talk about currency debasement, fiscal deficits, debt sustainability, and monetary policy normalization. Those are the silent drivers that are pushing gold prices to the moon. When central bankers and finance ministers gather in the Swiss Alps, they speak in very careful, highly diplomatic language designed not to spook markets. But if you know how to decode that language, if you can read between the lines, the message becomes crystal clear. They are deeply worried about debt sustainability. They are genuinely concerned about inflation becoming permanently entrenched in the system. They are aware that the tools they use to manage past crises, lowering interest rates and printing money, might not work as well or at all in future crises because those tools have already been used to their limits. Currency debasement is a term that sounds very technical and academic, but it simply means that your money is losing value and purchasing power. When governments print more money to pay their bills because they can T or 1T cut spending, when central banks expand their balance sheets to support markets and prevent crashes, the inevitable result is that each unit of currency represents a smaller and smaller claim on real goods and services. This isn't a maybe or a might happen scenario. It's already happening right now, today. The only real question is how fast it continues and how severe it ultimately becomes. Gold, which cannot be printed by any government or created by central bank decree, is the ultimate antidote to currency debasement. It is financial insurance that actually goes up in value when the things you are insuring against happen. Fiscal deficits, the gap between what governments spend and what they actually collect in taxes, are at levels that would have been considered completely unthinkable, almost criminal, just one generation ago. Countries are running massive deficits, not just during emergencies or deep recessions when you might expect it, but during supposed times of growth and stability when they should be paying down debt. This means debt levels just keep climbing higher and higher with no end in sight. At some point, and no one knows exactly when that breaking point is, markets begin to seriously question whether this debt can ever actually be repaid in real terms. When that questioning begins and doubt creeps in, bond yields spike dramatically. Currencies weaken rapidly and gold absolutely shines. Whether you're holding gold to protect your family's future and preserve generational wealth, or looking for what could be the trade of a lifetime, remember one fundamental thing. Gold is not getting more expensive. Let that sink in. The currency you use to buy it is simply losing its value. This is perhaps the single most important concept to grasp about what's happening. When we say gold is at $4,700, we're measuring gold in dollars. But what if we flipped that around and measured dollars and gold instead? Then we would say that the dollar has lost tremendous value over the past few years. Each dollar now buys you less gold, less purchasing power, less security, less of everything that matters. This perspective shift changes absolutely everything about how you view the situation. It means that rising gold prices are not necessarily a sign that gold is in some kind of speculative bubble, but rather a clear sign that currencies around the world are in serious trouble. It means that the people who have been patiently holding gold through years of sideways price action, enduring criticism and mockery from friends and family, were not foolish or old-fashioned or stuck in the past. They were wise and forward-thinking. They understood something that most people missed. It means that the real question facing investors is not whether gold will keep rising in price, but whether the currencies we use every day will keep falling in value and purchasing power. And the answer to that question is almost certainly yes. The rally to $4,700 is just the opening chapter of a much larger story that will unfold over the coming years. If the structural problems in the global economy, excessive debt loads, persistent inflation, geopolitical fragmentation, and conflict continue to worsen, and frankly, there's every indication that they will get worse before they get better, then gold has much, much further to run. Some long-term forecasts from highly respected analysts who have been right about major market moves in the past now talk about gold potentially reaching $8,000 or even $10,000 per ounce within the next 5 to 10 years. These numbers sound extreme and almost ridiculous until you sit down and actually do the math of currency debasement over that time period. Then they start to look not just possible, but probable. History provides us with extremely valuable lessons if we're willing to learn from them. Every single time a major currency system has faced a genuine crisis of confidence, gold has emerged as the clear winner. In the 1970s, when inflation ravaged Western economies and the Bretton Woods system that had governed global finance collapsed completely, gold went on an incredible run from $35 per ounce to over $800. That's more than a 20-fold increase in less than a decade. In the late 2000s, during the financial crisis and its aftermath when the world seemed like it might end, gold tripled from around $700 to over $1,900 in just a few years. Now, here in the 2020s, we are facing challenges that in many ways are more complex, more interconnected, and potentially more dangerous than either of those previous historical periods. Stay focused on what matters, stay properly hedged against currency risk, and watch the gold charts closely, because history is literally being written in real time right before our eyes. The decisions you make in the coming weeks and months about how to protect your wealth and position your portfolio could have consequences that echo for decades and affect not just you, but your children and grandchildren. This is not about getting rich quick or chasing the latest hot investment that everyone is talking about. This is about recognizing a fundamental shift in the global monetary order and responding to it with intelligence, prudence, and courage. For those who are relatively new to gold investing and feeling a bit overwhelmed, the first step is always education. Take the time to understand the difference between physical gold, which you can actually hold in your hand or store in a secure vault, and paper gold, which includes gold ETFs, mining stocks, and futures contracts. Each has its place in a well-diversified precious metals portfolio, but they are definitely not the same thing and come with very different risk profiles. Physical gold gives you that zero counterparty risk we talked about earlier. You own it outright. Paper gold is more convenient and liquid, easier to buy and sell quickly, but it comes with dependencies on financial institutions continuing to function and markets remaining operational. Consider carefully your time horizon and your specific goals. If you're looking to protect wealth over the long term, to preserve purchasing power across decades, physical gold in the form of coins or bars absolutely makes the most sense. If you're looking to actively trade and take advantage of shorter-term price movements, gold ETFs or futures might be more appropriate for that portion of your strategy. If you believe that gold mining companies will benefit tremendously from higher gold prices and want leverage to the gold price, then carefully selected mining stocks could offer potentially greater returns, but with significantly higher risk. There is no single right answer that works for everyone. It depends entirely on your individual situation, your risk tolerance, your investment timeline, and your financial goals. But whatever approach you ultimately choose, the key is to act with clear intention and deep understanding, not driven by fear or greed. The investors who do exceptionally well during major market transitions are not the ones who panic and make emotional decisions. And they're not the ones who greedily chase every hot tip. They're the ones who educate themselves thoroughly, form a coherent thesis based on facts, and execute a well-thought-out plan with discipline. Right now, at this moment in history, the thesis for owning gold is stronger than it has been in many years, perhaps stronger than it has ever been in modern times. The question is whether you will recognize this extraordinary moment for what it truly is and respond accordingly with action rather than hesitation. The clock is ticking, the charts are speaking loud and clear to anyone willing to listen, and the opportunity of a generation is right in front of us, staring us in the face. Will you seize it, or will you look back years from now wishing you had acted when gold was still only at $4,700? The choice, as always, is yours to make.